Okay, let's kick things off with something that sounds, well, completely nuts. Imagine this. You walk into a bank, ask for, say, $1 million.
Mm-hmm.
No paperwork, zero collateral. They don't even check your credit. And they just hand it over instantly.
Right. Sounds impossible.
And then, like 5 seconds later, you give it back. And the bank's totally cool with it. It sounds absurd, doesn't it?
Oh, absolutely. It totally sounds like science fiction or maybe some kind of heist movie plot.
Yeah.
But yeah, that seemingly impossible thing, that's pretty much the world of flash loans and crypto.
Exactly. And that's why we're doing a deep dive today. We're looking at one of DeFi's, it's the decentralized finance, of course, those, I guess, revolutionary tools, flash loans.
Mm-hmm.
They genuinely let anyone, like anywhere, borrow huge amounts of money instantly, no collateral needed. But, and this is the mind-bending part, there's a catch.
A huge catch.
You have to pay it back, not just quickly, but in the exact same transaction, within the same block on the blockchain.
Yeah, it's a completely new way of thinking about lending, really. So our mission today is to unpack how this works, this, groundbreaking, but let's be honest, pretty controversial tool.
Right.
We want to explore what it's used for, the good stuff, and also really shine a light on the risks, because they are significant. It kind of forces us to rethink what finance can even be.
So that core condition, the instant repayment, that's key. But let's dig into that impossible loan idea a bit more. What does no collateral, no paperwork, no credit check actually mean here?
Well, it means exactly what it sounds like, strangely enough. There's no traditional underwriting, no background checks, because the risk, it's handled differently. It's mitigated by the atomic nature of the whole thing.
Atomic nature?
Yeah, atomic transaction. You're not paying it back tomorrow or next week or even in 10 seconds. It's immediate, like within the same blockchain block. Think of it as one single indivisible operation. Everything packed into that one transaction either succeeds, all of it, together, or the whole thing fails. It just reverts. Poof. Like it never even happened. It's all or nothing.
Wow. Okay. So it's not just fast. It's almost like risk-free for the lender, because the money never really leaves unless the repayment is guaranteed in the same breath.
Exactly. From the lender's perspective. Yeah.
Yeah.
Which is a massive shift from how traditional banks work.
Absolutely. But, okay, given this all-or-nothing rule, why would anyone do this? How do you actually use a loan that just vanishes in, what, milliseconds? What's the point of borrowing millions if you have to give it back instantly?
Right. That's the key question. And the most common answer, the sort of classic example, is arbitrage. It's actually a really powerful use case.
Arbitrage. Okay. Like spotting price differences.
Precisely. Imagine you see some token trading for $1 on decentralized exchange A, but on exchange B, it's going for a lot or 10.
And 10% difference. Okay.
Yeah, a clear profit margin, right, if you can move fast enough. So you could use a flash loan. You instantly borrow, let's say, $100,000.
Okay, got the 100 grand, but it's only there for a split second. Now what?
So within that same atomic transaction, that single instant operation, you use the $100 K to buy the tokens on exchange A at $1 each.
Got it.
Immediately, still in the same transaction, you sell those tokens on exchange B for $1.10 each.
Ah, making $110,000.
Right. You pocket the $10,000 profit, well, minus fees, but you get the idea. And then, crucially, you pay back the original $100,000 loan. All of this happens like bundled together before the transaction is confirmed on the blockchain.
Right.
If every step works, the whole thing gets validated, the block is confirmed, and you just made 10 grand out of thin air, basically.
But hang on, what if something goes wrong? Like the price on exchange UB suddenly drops while this is happening, or one trade doesn't execute properly. Does the lender just lose their $100,000?
No. And this is the genius, or maybe the weirdness of it, that no harm, no foul mechanism if any single part of that complex chain of actions fails. Like if the price slips, or the second exchange doesn't process your sell order in time, the entire transaction just gets canceled, reverted.
The whole thing?
The whole thing. It's as if it never happened. The loan was never issued. The first trade never happened. Nothing. The lender's funds were never actually at risk because they couldn't be permanently sent without the repayment being part of the same atomic package.
That's wild. It really is like a high-wire act, but with this automatic safety net built into the code itself.
Pretty much, yeah.
Okay, that really sets the stage for how revolutionary this is. It almost sounds too good to be true, like magic. But if it's so safe for the lender, why is it also seen as, one of the most controversial things in DeFi? This is where it gets interesting, right? The whole dual nature thing.
Exactly. It's fascinating how one piece of tech can be used for such opposite ends. I mean, on the good side, like we discussed, you've got savvy traders using them legitimately for arbitrage, like the example.
Right.
Or even, say, refinancing debt.
Right.
You might have a loan on one DeFi platform and you see a better interest rate on another. A flash loan lets you instantly pay off the first loan and take out the second one all in one transaction without needing your own capital upfront. It's about capital efficiency.
So for smart, legitimate players, it's a tool to make markets work better, faster, or efficient.
Okay.
Okay. But then there's the dark side. You mentioned devastating attacks. What does that actually look like? How can hackers use something that needs to be paid back instantly to attack?
Yeah, unfortunately, that's the flip side. Hackers have definitely weaponized flash loans. They use that massive temporary capital to manipulate market prices or drain liquidity pools on exchanges or find and exploit subtle bugs in smart contracts.
And this isn't just theory.
Oh, no, not at all. We're talking hundreds of millions of dollars lost in real-world attacks where flash loans were the key ingredient. They provide the leverage, the financial firepower needed to pull off these exploits.
Can you walk us through an example? Like, how does a flash loan attack actually work? Because the idea of stealing money but then giving it back, it's still a bit hard to grasp.
Sure. Okay. Imagine a hacker. They take out a massive flash loan, millions of dollars.
Okay.
Step one. Step two. They use a chunk of that borrowed money to, say, buy up a huge amount of a specific, maybe less liquid token on one particular decentralized exchange. This artificially pumps the price way up.
Creating a fake high price.
Exactly. Now, step three. There might be another DeFi protocol, maybe a lending platform, that uses the price feed from that first exchange to determine collateral value. Because the price is now artificially high, the lending platform thinks the hackers, perhaps otherwise worthless tokens, are super valuable.
I see where this is going.
Right. So the hacker then uses those artificially inflated tokens as collateral to borrow different valuable assets like stablecoins or ETH from the second platform. They borrow way more than their initial collateral was actually worth.
Because the system was tricked by the manipulated price.
Precisely. Step four. Having extracted the valuable assets, the hacker then unwinds the initial price manipulation, maybe sells back the first token, and then crucially pays back the original flash loan, all within the same transaction.
So they return the borrowed millions?
Yep.
But they walk away with the other valuable assets they managed to borrow illegitimately from the second platform by tricking it. The flash loan wasn't the theft itself, it was the crowbar used to break into somewhere else.
That's a great way to put it. It's the enabler. It's like, the analogy I've heard is like a bank robber who instantly returns the getaway car, but they still have the loot they stole from the vault. It all happens atomically, making it incredibly hard to stop once it's initiated. It just highlights how vital security and careful design are.
Yeah, no kidding. This really paints a picture of, well, the Wild West aspect of some parts of DeFi, doesn't it? What does this mean for decentralized finance more broadly?
Well, it's important to stress again, not all flash loans are bad. Far from it. They actually showcase something incredible, the power of programmable finance.
Programmable finance.
Yeah, the ability to code complex financial operations that execute automatically based on predefined rules. This is something traditional banks, they can't even dream of doing this stuff. It's not just about speed or no collateral. It's about shifting where trust lies.
How so?
Instead of trusting a bank or a counterparty over days or weeks, you're trusting lines of code to execute perfectly in milliseconds. The trust is in the math and the code, not an institution. That's a radical shift.
So the code is the law, in a way.
In a very real way, yes.
Yeah.
But these attacks, they also teach really critical lessons. They hammer home the absolute necessity for, super secure coding practices, rigorous audits, and sophisticated risk modeling in this space. You have to anticipate these kinds of economic exploits.
It sounds like it forces the whole ecosystem to constantly level up its security game. It pushes the boundaries, but also exposes the weak points.
It absolutely does. Developers, auditors, platform designers, they have to think adversarially. They have to consider how these tools could be misused because the potential fallout is huge. And ultimately, it encourages you, the listener, to see DeFi as more than just, buying some coins or chasing yield.
Right.
It's this really complex, innovative frontier where entirely new financial building blocks are being created almost in real time. And there's this constant tension, this balancing act between enabling incredible innovation and ensuring robust, ironclad security.
So wrapping up, we've looked at this Pretty mind-bending concept. Borrowing millions. No ID check, no paperwork, zero collateral. As long as you promise, pinky swear, to return it before anyone even blinks.
Yeah, it's really a testament to what becomes possible when finance is built directly on code. It's fast, it's definitely risky, it's quintessential DeFi, and it's called a flash loan.
It really is this ongoing frontier, isn't it? Financial innovation, pushing boundaries, but constantly bumping up against that essential need for security. It makes you think, what does this kind of power, this programmable money, mean for the future? For how we think about finance, about risk, about technology itself? Definitely something to chew on. Stay curious.